With the suite of macro trend indicators I have developed, driven out of a strong desire to understand the inner workings, ebbs, and flows of the stock market, I now have a great tool to help me identify the market bottoms and tops. I am much more confident that with this tool, I can make sound trading decisions to buy low and sell high, not in the small cycles but amidst the major cycles, finding the major bottoms and major tops. Let me show you an example how this tool can help. Go to the macrotradings.com website and members area, find the trends section. Here you can see many trading approaches like finding major bottoms and tops, the associated indicators to use, and the recommended common sense trading strategies. Let's take a look at the 3 indicators which can help to identify the major tops. The first one, RSI divergence and negative sentiment. Let's click on it. This indicator can find spots where the S&P 500 or SPY ETF have an RSI divergence with the index or ETF value, followed by a sentiment shift to the negative. Very often this occurs before a major market top, as we can see in Nov 2022, and also in March 2020, just before the market crashes began. Let's take a look at the second indicator, equity put-to-call ratio, which measures the amount of equity puts to the amount of equity calls, a proxy of the retail trader's overall sentiment. When the ratio is high, it means there are lots of puts and fewer calls, indicating an overall bearish sentiment. On the contrary, when the ratio is low, it means there are lots of calls and fewer puts, indicating an overall bullish sentiment. However, it's a contrarian indicator because when the herd is fearful, it usually means the bottom is near, and when the herd is greedy, it usually means the top is near. On this chart, we can see an inflection of the ratio value turning from downward to upward direction occurs at every major or minor top. It can be used as another guiding signal to detect the market tops. Now lastly, let's look at the signal breadth deterioration, which looks at the percentage of stocks above the 200-day moving average of the S&P 500. Every top before a bear market materialize will be accompanied by a decline of this value as more and more stocks in the market drop below their 200-day moving average. For example, in the second half of 2021, when the bull market was still in full force, the percentage of stocks above the 200-day SMA was actually on a continuously decline. A clear warning signal to be extra cautious. Reflecting the mindset I had during that period, I was still pouring more capital into the market to chase the growth stocks. Pure stupidity in hindsight. You can also observe for a closely related indicator about the percentage of stock above the 50-day SMA. Although it was going up and down throughout this period, the overall trend was still going down, confirming that Wall Street was rotating money to brace for the bear market impact. So there you have it. This is the painful lesson I've learned about not able to sell high in the stock market. Though as simple as it may sound, it was actually very hard to execute when all the news around you is exuberant and stocks to the moon. However, I now have a great tool at my disposal to help me filter out the noises and see what's really going on behind the curtain. If you are interested in leveraging this too, please sign up for the membership at macrotradings.com and you will have this full suite of powerful indicators to assist with your trading. Stay tuned for my next video where I will deep dive into my second fatal mistake and how other indicators could have saved me from my mistake. Thanks for watching.